is a presentation of TFNN. The Global Market Pulse with your host, John Logan. Call now, toll free at 1-877-927-6648. Internationally at 727-445-1044. Now, John Logan.
Hi, guys. Well, again, the gap ups, the gap downs, par for the course. We are gapping down this morning, and let's see how many S&Ps we're gapping down. About 17 at the time of this report here. So what do? You know, we had an incredible rally yesterday afternoon after an incredible pullback. It all happened. Let's just pull up our 60-minute chart here. And this all happened within about an hour and a half. So we were up, and just to, not to be a Monday morning quarterback, just want to kind of walk through this. And, you know, yesterday morning we had, and I'm looking at our 60-minute right now, and I'm looking, and I'm focusing. Let me just tell you where I'm focusing. Let me get back to our 240 for a second. All right. So yesterday morning, we were at around this area right here, and we were talking specifically about the numbers 48 around that general area, and that was the top of the box on our 240s. And we looked at this as, you know, we have to get back down below this 48 area to get relatively energetic about putting on the shorts. And obviously that didn't happen until basically, you know, the last, what was that? Last 2 hours of the trading day, we poked our head down below. But I want to walk through the mentality of this, because I opted out on those shorts below there yesterday in the afternoon, because when we get a violent pullback like that into these inflection points, and we haven't, you know, the morning time yesterday, I was hoping that we could get down below 1948. And we've got a lot of long-term investors that watch this show, and I'm really specifically talking about day-to-day actions in the indices, the oils of the world, the things like that. So what I want to do is also, you know, speak a little bit from a higher level and a longer-term view in a second, because the guys who are, again, long-term investors are thinking, well, God, you know, he changes his tone every day, and how do I make sense of that from a portfolio management standpoint? You know, and that being said, I'm not a big fan of holding things long term right now. You know, we've been talking about that since we were spinning around between 2050 and 2150. That seemed to happen for about almost a year, and you know, the leverage has always been, in my opinion, for the long-term investor, that it was, you know, the risk was to be long. So being in cash, again, telling people what should have happened in the past. I apologize for this, but we've been stating it on the show a lot. For the long-term guy, I still think this is not a dip to buy. I think we could head much lower, and the day-to-day, you know, noise that's happening now, we broke stride yesterday morning and started breaking above this 45-48 area. And that's why on a day trading or a kind of a swing trading situation, you have to sit tight. And, you know, case in point, I mean, I said yesterday, we could go much, much higher, right? And the much, much higher literally is hitting an inflection point up top around 2050. I know you guys don't want to hear that, but that's basically getting, and that's a daily unfurlough, and that's basically getting back near that weekly breakdown area around 2060. You know, do we have to get there now? Do we ever have to get there? No. But if we don't get back into sanity and start getting below, you know, the 240 kind of regulates the trade down, as you can see from that 2150 area, or 21 whatever, 21010, 2105. When we started breaking down and getting the momentum below the 2085 and the 2060, which we've been talking about, if you watch this show, you know exactly what I'm talking about and why those areas are significant. The 240s kind of regulate the trade down, all right? And as we broke above the 240s, that means, you know, at least on a relatively short-term basis, that we've got to sit tight and wait again, because, you know, We had some opportunities around the 1910 area. That worked out okay. We tried again around 45, 48. And that was near the close when that happened. I think that was on Wednesday? Yeah. So that was, again, trying to hold an overnight trade, which I don't advise. And then yesterday morning, we're rattling around having some technical damage on the upside. And we reached a high yesterday. I don't have to tell you this. Before we sold off, we reached a high yesterday of around 1985, all right? And I think we ultimately hit a high of 1992. I mean, these are massive moves. I don't have to tell you this. These are 500-600 Dow point moves on a daily basis. But this is why there's nothing up here. We talked about, next stop up is way up there. So we want to, have some sanity to this. And yesterday we were hoping we could get below 1048 or so. And at the end of the day, and I'm going to go back to my 60-minute now, nobody could foretell this. I mean, and again, if you were short all day and continue to dollar cost average into those shorts, this ended up working out for you. But we could have had a massive spike straight up at the end of the day and never had this pullback. So I would consider yourself getting lucky on that. But when we pull back that violently right into that area from the 240s, that was the breakout point. As you can see, we poked our head. I think we went as low as 1944, 1945. I was considering that, this is the reversal we were looking for. It was very late in the day, and what do you do with this? But practically a 50-point pullback, 50-point pullback in the S&Ps. I wasn't that interested in shorting something after it pulled back 40 or 50 points. I mean, things don't go in a straight line, and lo and behold, it got back above that 2040 or 1948 area pretty quickly. So, what do you do now? I pretty much didn't trade yesterday. I wish I was sitting there going, why can't I be a daring guy and go in here and short things on their highs? Because again, that could have gone straight up again without that pullback, and you don't have the leverage on your side. You have nothing to hang on to here. And I was like, okay, wow. And then, obviously we had, and let me just put this into perspective. From 1945 to 1990, within 60 minutes, I mean, that's an incredible move. So I didn't catch any of this. I'm not a big fan of going long, and I didn't feel comfortable going short in the hole like that after we had talked about the Maginot line we had to cross. All right, so no points were made or lost yesterday on my book, and that's just the way we look at it. Here's the situation now. Here's our S&Ps futures. There's a new profile that's appeared while you guys were sleeping, probably 1986, 1987. Am I comfortable today placing stops above that area and hoping we can get back down to 1946, 1948, that area down there? Might not happen today. We're in a relatively wide profile for a 240-minute. I'm just going to give you the landscape the best I can on this thing right now, because I know you guys are. This is a barometer to trade internals, the instruments within the S&P. So we're going to talk about this a little bit and try to figure out where the leverage is. Considering the action that happened yesterday, that was, in my book, relatively bullish, with coming back right down into those inflection points and the noise level factored in, and a powerful rally like that. So right now, you got a relatively wide profile, and that profile is 40 S&Ps tall, all right, on a short-term time frame. The VIX is still, and I'm going to pull this up really quick. Let me just get the right month code up here. Let me see if we got, hold on. All right, this is September VIX futures. We're still up there, 25. I think that's the same for October too. But so, what does that tell you? That tells you that obviously there's going to be volatility. The 240-minute box tells you with the height of it, there's going to be extreme volatility. And if you drill down into the 60, which is kind of amazing, you've got the same wide situation. So what do you have to hang on to if you got not a big fan of trading these S&Ps until we get into major inflection points. And on the weekly and daily, there's nothing there. There's something at 2050 as we looked at, but right now, on a short-term basis, you've got 1986 up top, which is very similar to the 240 on for highs, and you've got 1953, 1954 down below on the 60-minute. You've got a POC at 1968.50, and this is all going to come together in a second. Here's the 240s. You got 1946 down below. So what do you do with this, and where's the leverage? In my opinion, it's Friday. Well, that's not my opinion. That's actually a fact. Since it's Friday, my opinion is we've had a hell of a week. We've had a lot of volatility. Some people are tired. We're probably not going to have any big moves today. We're not going to have any big moves down or big moves up. Some folks are going to want to be flat going into the weekend, and some guys who have been short are going to want to be flat going into the weekend because they're licking their wounds a little bit down here that they possibly added to their position and not scaled out relative to stops based on this 1946, 1948 area. So you're going to have some. It's not like everybody who's long is going to be covering and the market's going to fall. You got some people that are short that are going to be covering because, China over the weekend, especially Sunday night, could come out with some new measures. They got plenty of tools in their belt. They can make unconventional statements and actions based on just the sole concept of trying to save their citizens' money in the Chinese stock market. I mean, they could literally shut the exchange down if they wanted to, and keep it down. So anything can happen, and they can do some new currency innovative type things, cash injections, things like that. So again, you never know what's going to happen by Sunday night U.S. time and Monday morning in Shanghai and Beijing. So what's the situation here? I think we're going to be pretty directionless today in the S&Ps, and we're going to bounce around possibly within a big wide range, and you're going to have to drill down into much lower time frames, namely the 60, which is again relatively wide, and you've got 1968.50 sitting here as the top of the hill for the S&Ps in that range. And what does that mean, top of the hill? That means we could roll down one side or the other. I'm not a big fan of trading POCs most of the time, but when you have relatively wide profiles, you've got to pay attention to them. You got another POC at 1957, 1958. So you got 1968, 1958. And we're going to keep talking about this when we come back from break, guys.
TFNN is excited to offer a brand new piece of market scanning software unlike anything the industry has ever seen. John Logan and his team have spent years developing their market profile tools to finally be able to release the TAS Profile Scanner Plus. And right now you can get a 2-week trial absolutely free just by visiting TFNN.com and providing us your name and email address. The TAS Profile Scanner Plus is the premier market profile-based scanner in the industry. Powered by the acclaimed TAS proprietary algorithms, this feature-rich scanner is a standalone desktop software that instantly filters over 2,500 global financial markets such as stocks, ETFs, commodity futures, and Forex. Within 3 minutes of signing up, you can have the software downloaded and running on your computer with a complete roadmap of market indicators and inflection points to trade off using the TAS Profile Scanner Plus. Sign up today and try this amazing piece of software by visiting TFNN.com.
Tiger TV is an exciting way to experience TFNN programming. See high-definition video, giving you crystal clear charts, as well as seeing some of the faces of TFNN's highly acclaimed financial experts with crisp, full-fidelity sound. Catch Tom O'Brien, John Logan, Steve Rhodes, Basil Chapman, Larry Pesavento, Think or Swim, David White, Andy Hecht, and Daryl Martin in crystal clear, high-definition audio and video. Tiger TV, exclusively at TFNN.com. platinum, grains, crude oil, gold, copper, cattle, hogs, gasoline, natural gas, coffee, cotton, cocoa, and sugar. These are just some of the commodities mentioned in the most recent issue of Andy Hecht's Technomental Commodity Report. Andy publishes his weekly newsletter every Thursday morning, where he breaks down the commodity market and provides his subscribers with specific trading recommendations based on his trading methodology. By signing up for a free trial to the Technomental Commodity Report, you'll get a full 30 days to try out this powerful newsletter service and see for yourself the types of trades Andy has recommended for his subscribers. When you sign up for a 30-day free trial, you're under no obligation to pay anything. And should you decide to continue, you will lock in the low rate of only $79 a month. Sign up right now for the Technomental Commodity Report and make sure you're ready to catch the next big trade in commodities. For more information and to get started today, visit the front page of TFNN.com.
Until recently, it was almost impossible for the average investor to hedge against currency risk in Europe or Japan. For a bold trade on Europe or Japan that protects against moves in currency, trade HEGE or HEGJ, 2 times currency hedged leveraged ETFs from Direction Investments. Visit directioninvestments.com today. An investor should consider the investment objectives, risks, charges, and expenses of the Direction shares carefully before investing. The prospectus and summary prospectus contain this and other information about Direction shares. To obtain a prospectus or summary prospectus, please contact Direction shares at 866-476-7523. The prospectus or summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors. Distributor Foreside Fund Services, LLC.
Many of our new listeners have heard about the Tiger's Den, but wondered, what exactly is it? The Tiger's Den is a lively community where professional traders and investors can meet, exchange ideas and information in a comfortable, moderated atmosphere. Hear all of your favorite TFNN shows, plus see all the charts as they happen live during those shows, and have access to all those charts. You can test drive the Tiger's Den absolutely free for 30 days. It will greatly enrich your knowledge of these markets. Details on the Tiger's Den are on the front page of TFNN.com. John takes your phone calls. Now. Toll free at 1-877-927-6648. Internationally at 727-445-1044.
Hi guys, welcome back to the show. We're finishing up with the S&Ps here, and gonna try to cover some of the long-term views. Talked about a lot of short-term views, relatively speaking. I mean, the thing basically for the long-term guy is, kind of looking at these. We've got, the Jackson Hole thing going on. We've got who knows what's going to happen next in Shanghai. We've had the break below 2060, and again, I think we could possibly have some more sell-offs. I mean, this is not a big come off the all-time highs here. Very much, and if things settle out and the market kind of drifts higher, let it get above some technical levels. Let it start showing some concert within the internals to get back in the water. That 2060 break, you should have paid intense attention to that. As a long-term investor, we've been kind of beating the table about that. We've also talked about monitoring our long-term breadth that weekly, namely when we started having this situation. We talked about this. I mean, this doesn't happen that often, and you're not going to pick the tops and bottoms looking at this long-term indicator. But the last time, and I'm going to show you this, I'm going to expand this out. We have these crossovers, right? These are weekly. This happened on September 26th. We had a 200-point sell-off up until, late October. But these are kind of bearings of bad news when these things cross over for the long-term guy. If you have this scanner, you'll get hip to this. But again, it's been kind of balancing since the 1st of June. We started getting the signals. And if you notice, the last time we got that signal was October to get long the S&Ps. On a long-term basis, it was okay to be long. We've had a lot of mixed signals with our daily breadth in between there. That's why we've kind of been looking on a short-term basis, or we were looking to sell resistance all along the way. If you watch this show, I haven't been saying buy the dip for a long time. And when we got that June 4th situation, we had a couple of rallies that were fake rallies, and those were, fake categorized based on, what's going on with this internal indicator. But right now, breadth is still ugly on a weekly and a daily. Here's our daily breadth. And you can see where this thing broke, and this thing's on a price scale is on a relative sense down below. And we always talk about the 60-minute being the short-term indicator, just blindly do what the crossover says. But, the long-term stuff for the long-term breadth for the long-term guys out there, we're not out of danger by any means. So, and I know you can take the attitude, you got to buy when there's blood in the streets. I mean, yeah, okay. When there's blood in the streets in 2008, let's see. February, there's blood in the streets. Oh, let's buy. March, there's blood in the streets. Oh, let's buy. If you're going to be right at some point saying anything. I mean, at some point, statistically, it's impossible to not be right. But, there may be more blood in the streets. And if you start, pulling a JP Morgan and, following suit on that, I mean, blood in the streets is a full-blown depression, all right, where people are standing in a soup line. This is not that situation, guys. All right. There's no banking nightmare right now. There's no currency war yet completely. I mean, there's not blood in the streets. I mean, we've come off all-time highs this much. So, might want to sit tight on this one from a long-term standpoint. We could rally and I could be wrong, and we could make all-time highs again in a week, and that would be amazing. But I think you always try to manage your risk as a long-term investor. If you don't have money to play around with, and you're trying to, you know what I'm trying to say. So anyway, we're going to take a look around the globe a little bit here. Let's take a look at the Shanghai. Digressed a little bit there. Here's the weekly. That break at, this is the big number, 35.54, and you got 35.44 now sitting daily on fair lows. So that DMZ between 35.44 and 35.54, that's the ultimate retrace back area. If we get up into that area, I think the Shanghai could be sold on a long-term basis. Again, right now, it's poked its head up above the regulator, the 240, 31.62. So that's the big number on the Shanghai on the short term, 31.62. Getting back below there, we could explore the fair auction down to 29 and some change again. But if we hang around above 31.62, we could drift higher into 3,500 again. Let's take a look at the dollar. This is something I'm intensely watching for a weekly close above 95.30. I like this reversal, and we're going to talk about this a little bit more when we come back and how this impacts the rest of the market.
If you're an active trader looking for that extra edge when it comes to trading and investments, then now is a great time to get a 2-week free trial to Tom O'Brien's daily market letter, Market Insights. Tom O'Brien's daily newsletter, Market Insights, comes out every market day at around 9:30 a.m. and provides Tom's daily commentary on the broad market, including the Dow, NASDAQ, and S&P, plus specific trade recommendations. There's even an update published most afternoons to keep you informed about the day's market activity. He'll give you the entry price, price target, and stop price of each stock and option trade. With Market Insights, there's nothing left to guessing. For all the details and to get your 2-week free trial to Market Insights started today, visit TFNN.com.
Today, it's hard to tell if the economy is coming or going. Regardless, I want my money going in the direction I choose. If that's your stance as well, then you want to know how Everbank can help keep your money thriving just the way you want. Is growing your money a priority? Everbank is committed to a yield pledge promise to pay high yields on your checking, money market, and CD balances. Looking to diversify? Everbank ingeniously developed accessible ways to spread your money around the world into foreign currencies and even non-FDIC insured metals. And when it comes to your wealth, they bring a highly experienced and global perspective to help you manage it. Everbank's financial philosophy flies in the face of the status quo. They believe your money's performance should not be determined by today's economic circumstances, but by the drive to rise above them and create opportunities that favor your objectives. If that excites you, like it does me, call 1-855-750-4051 to find out what they can do for you. That's 1-855-750-4051. Call them today. Everbank is a member FDIC and equal housing lender.
TFNN is excited about our new software charting program, The Art of Timing the Trade Charts. In collaboration with Tom O'Brien and using his best-selling book, The Art of Timing the Trade, Your Ultimate Trading Mastery System, David White has programmed an outstanding piece of software that will complement any trader's methodology. Using this first-of-its-kind program, The Art of Timing the Trade Charts allows you to scan thousands of stocks for Fibonacci formation setups, including Gartley's, ABC's, butterflies, and much more. The Art of Timing the Trade Charts is designed to help you when scouring the markets for stocks just beginning to form the trading patterns that many investors spend days, weeks, or even months searching to find. And right now, we're offering licenses available at only $79 a month. We are so confident that you're going to love this new charting software that will even give you a 30-day unconditional money-back guarantee. Don't miss out on this incredible new piece of software. Get your copy of The Art of Timing the Trade Charts today by visiting TFNN.com. Larry Pesavento has just started his brand new service, Fibonacci 24/7, and he's already delivering content to his subscribers on a daily basis when the market's opened and even on weekends. Each Monday, you'll receive Larry's written report that provides detailed commentary and a summary on the charts and videos that Larry sends out. And throughout the week, when warranted, Larry will send out via charts or videos or both the key markets that he is watching during the day. This will be up-to-the-date, active trading information that will help you in your daily trading. In Larry's first week alone, he sent out 25 charts, 6 videos, and a full report to his subscribers in just 1 week. If you're a technical trader that uses patterns and retracements to trade, then Larry's service Fibonacci 24/7 is something that you must try. Right now, new subscribers can get a full 30-day money-back guarantee. With nothing to risk, sign up now to Larry Pesavento's Fibonacci 24/7 by visiting the front page of TFNN.com under Trading Newsletters.
This segment is brought to you by Think or Swim. For more information, just click the Think or Swim banner on the front page of TFNN.com.
Hi, guys. Welcome back to the show. We were talking about the dollar. Let's finish with that. This is crude oil. I wanted to show you how cool this was. For the long-term guy, we'll get in that in a second. I'm getting ahead of myself. Let's take a look at the U.S. dollars. Finish up with this. Again, the big number. Let's just take a look at the daily here. We had this new profile up here. We're kind of rattling around above this 95.27 and 95.30. Let's just call it 95.30 just to consolidate that idea. But a weekly close above that number now, in my opinion, you can use 95.30 with your noise level and appetite for risk factored in to place stops below. And I know if you didn't pick this up on sale around 93, you're not that happy. But again, there was no leverage down there. That's what we talk about all the time. I mean, this thing could have gone way farther south, but because it eclipsed these recent lows and reversed and got back into the fair auction. This is what we call the fair balanced area that it's in right now in the long term, between 95.30 and 99.50, up in that area, the very long term. So if we have a weekly close above there, then I'm going to feel okay getting back in the water, because now I've got something to lean against, a fence, if you will. And I can place my stops relative to that. And we are always focused first on this show in playing defense. All right, I want to say that again. The first thing you tell a proprietary trader, and Larry's seen this. There's quite a few folks that have been involved with this type of environment I'm getting ready to explain. The first thing you tell that guy is figure out how to play defense. And this is the platform that we're going to give you to play defense on first. The offense will come later. Figure out how not to lose money. All right. And if you guys are just starting out, I'm not playing God today. I'm just telling you from experience. If you are just starting out trading, that's the first thing. I don't care what the latest guru on some kind of internet blog that's telling you he's going to make you $1 zillion in one day. If you see something like that, run, don't walk. The first thing you do is play defense. You figure out how to not lose money, and you will probably get chopped up a little bit. All right. But you want the tuition fees to be small. All right. Trade small, play defense. The clouds will part at some point, and you want to have all the capital you hopefully initially started with to move forward with and start ringing the register. All right. These are words of wisdom from somebody who's seen a lot of things. And Larry next will probably tell you this exact same thing. All right. So let's move on. Let's get into crude oil here really quick. All right, this is the deal in crude oil. Now I got a little bullish around 41.74 on the last month's contract. Looked at the XLE as barometer. Never really got into that trade. I can't pull up the last contract. Let me see here. But what happened? When we get down here again, it's like you don't have anything to hang on to. And we talked about crossing the border of 42 to really get long and have some conviction. The XLE got killed all of a sudden when that happened. But we had this orange bar appear here. All right. And what does that mean? If you watch this show, you know that means there's a new profile coming out. All right. And that's an indicator in itself, a new balanced area. So when that orange bar happened, and this isn't going back and repainting things selectively and making the chart look cool. This, is real time. And what happens is when you go into the future section of the scanner, you don't really need these charts. You're going to see WTI crude oil right there. You're going to see that, and this is the so-called level of the market. There's that 43.38 that we just came off of, by the way. And I'll show you that on the chart. But when you go into this crude oil scene, you'll see that peel back. You see that peel back on feeder cattle. You see it on live cattle. Why am I talking about cattle? But I'm just giving examples. So when you see these yellow peel back things happening, those are saying, hey, we're probably going to have a new profile appear next bar. And if we stay yellow peel back the entire bar today, that's going to happen. Now, is that usually like a buy point in this case, or a sell point as the market's rallying, any market rallying? What it is it's saying the move may be over on the downside for a while because we're going to have a new fair auction that prices will have to kind of figure things out with. This is an algorithm that outputs this automatically. This is not your grandfather's market profile where you have to kind of do all this hand stuff, use a lot of subjectivity, and then collapse everything after you've, artistically created these things. This is a very objective, rules-based situation that uses market profile, and I believe in it. So as you can see, crude oil, that's the thing. Okay, shorts need to probably scale out of some of these, lighten up, new profile. Okay, new profile's here, opening is here. We know these boxes. Then you've got a area right here. We didn't talk about crude oil yesterday, by the way. We just didn't talk about it on the show. 38.31 is the new floor. Now you can orient stops around it. And where's your targets up top? Your targets have been met already within 24 hours, 43.38. I know you guys are watching the news. You had like biggest move in crude oil percent-wise in, 6 years? But the cool thing is, again, focusing on playing defense, you knew where to put your stops on this. And if you have the scanner, and I hope you do, at least on a trial basis, you're going to be given these. There's WTI crude, and there's that 38.31 down there as I mouse over. You get a view of all the, the profiles right there. So, what's going to happen now? I'll tell you what is the situation here. I'm not exactly, you look at this trend. I'm going to get back in time here. You look at this trend and the latest breakdown below 60 on this month. We haven't actually had any technical damage yet. This is not a challenged situation, right? We had the bounce that, I think let me go back to the XLE really quick. Now this little situation, and the reason I'm pulling it up because we're let's see where we're at pre-market here, 63.80. Okay. All right, so we've got a new profile that appeared above price action on the XLE. That's relatively bearish. All right. We've also had crude oil come up into that inflection point and probably scare the heck out of every short in the marketplace. And we're back trading 42 here. So again, the XLE's come up into resistance. Crude oil's met resistance. We have no technical damage going on here, and the long pop trade is over. All right. Can we revisit 38? Yes, we can. Can you short this? Staying with the trend down? Yes, we got the pop. The XLE is looking a little compromised. Stops above 43.38. You can see how this has acted around that profile. All right. All right. I'll take a look at EEM in just a second. All right, let me go into grains really quick here. This is something I've been interested in. Obviously, if you watch this show, you know this. So yesterday, similar situation. On the short side, we had the orange bar appear, right? Now, orange bar got through the day, now new profile. So this was a takeoff point for beans. It's not necessarily a buy point, but it's, again, just like crude oil, all shorts. And I've been talking about, hammering this thing below 910 for a while and selling any resistance on November beans. That trade's over for a while. We could rally back up into that 910, 913 area. Interesting that the top of our profile on our daily and the bottom on our weekly are 910, 913. We can easily retrace there. And I'd love to see that happen because that would give us a chance to lay the wood on the short side to this thing again, right? So again, things don't move in a straight line. You're going to have some volatility. The trade is over on the short side right now for a little bit, and we could get a pop up to that 910, 913, and then you got a chance again to play defense around that level and see what happens because you got a decent risk reward on this one. Can beans keep going north? Yes, without question. All right. But again, we're trying to stick with the odds, turn the rents the same way every day, and play the numbers game. And that's all you're doing. You're speculating, right? When you go to the grocery store, you speculate if that apple's rotten or not. I mean, everything you do is speculation. And this is just trying to put the odds in your favor on that speculation. Let's take a look at the 10-year. All right. So, again, the targets up top on this thing were 129.14. The bottom of the range is 127.11, 127.14. We've talked about that a lot. Do I think the 10-year is going to do anything scary here or different? No. I mean, we've talked about whether they got Yellen's entire family in a closet feeding them through a hole. I don't know what's going on. They're not going to raise rates. All right. That's my opinion. If they do, we're prepared for it. All right. And prepared for it means stops below 127, 127, 14, based on your appetite for risk. Exactly. Peak D. I think that's kind of hitting home. Thanks for bringing it up. So let's take a look at EEM. All right, so here's the long term on this EEM emerging markets ETF. So again, a little bit of a reversal this week on the bottom from where we're at on the previous week. Here's the daily situation. I'm not a big fan of, this thing turning around. I mean, I think, again, turning rents the same way. You see how this has acted around these inflection points. 35.11. If we can get back up there, I think you got to take a shot on the short side again. I don't think any of this is over. We're having a world kind of arbitrage to reality situation going on right now. Is it going to be volatile? Can it scare the crap out of some shorts right now? Absolutely. But I'm not a big fan of just digging in and loading up on the long side. I mean, it's not the time to do that. I mean, we've had the technical damage. That's going to have to settle out and trade a little lighter Anything can happen. If the market goes your way and you are trading light, you've still done the right thing. I mean, one of the things that Schoenfeld, I mean, I know Steve Schoenfeld. It's like when times are volatile, you better be trading lighter, because the thing is the P&L situation, you want to stay stable. It's easy to say, and again, you guys are probably, thanks, Captain Obvious, but when you are trading, you want to look at it from a consistent monetary balancing act, right? So, you've got a certain amount of capital, and this is probably on some trading plan on the internet somewhere. You could probably look it up, but I'm just telling you as a fact that one of the smartest guys I know, one of the biggest gamblers I know, one of the best gen players I know, Steve Schoenfeld, and he runs a lot of proprietary traders. Look him up. We'll talk about that on another show. But the main thing is, every day your risk reward should be the same, and you should balance out that monetary risk equation every day. So, when you have these wild P&L swings, guess what? You're out of the prop group. I mean, that's just the way it is. And he only gives the rope to people, extra rope to people who, can manage that risk consistently. So, and again, you're saying, okay, well, I'm just a regular dude sitting at home and I'm not in a prop trading environment. Well, you know what? You should think like that, because that's the way people ring the register consistently. And that's the way they, go home every day with their ball and come back the next day and play. So here we are. Here's the euro. Talked about the targets on the downside here around 112 on that trade yesterday, in fact, and that's hit it and bounced up a little bit. Here's the daily unfair highs, and that's matching up with this POC on the weekly that we talked about. So the short trade getting back down below 114.67 into that area. I think we're kind of clean and clear of that trade right now. This was just a beautiful situation to reverse back below that 114. We talked about this is again another great example. Wait till you cross some of these borders and get some conviction. But here we go. We will now have to see a breach of that 112.08, 112.26 area, that DMZ, to start thinking about shorting this again. And if we rally back up into that 114.67, that's going to be another ripe opportunity on the short side. Right now, you're kind of in no man's land. I'm not a big fan of going long the euro. I'm looking at it from the short side, and that's the game plan for this thing. All right? Let me read the den here. A lot of comments. I can't read them. I'll read them on the break, and then I'm sure I'll have depressing comments about it, especially if it involves marriage. So here we go. Let's take a look at the Nikkei. Got to comment on this one, because now we're back up into that ripe area, 19,279. We've retraced all the way back up. Remember, keeping your powder dry and waiting for these inflection points to be approached so you can have some concrete areas to look at and to focus on. Now we're there. 19,279 stops above, just like the DAX yesterday, that we're going to look at when we come back. And there it is. We'll be right back, guys.
Has the current market volatility continued to stop you out of trades when the market spikes against you? Now is the perfect time to open up an account with Nadex. Nadex, the North American Derivatives Exchange, is a brand new, completely regulated Chicago-based exchange, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their completely free trading platform, which also features real-time charts and full customization capability. One of the advantages of trading with Nadex in volatile markets is that your risk is always capped and you have the ability of keeping your trades open even when the market spikes against you. Nadex is completely brand new with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's NADEX.com. or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors.
Tom O'Brien's weekly gold letter, The Gold Report, gives complete and concise coverage of the entire gold market. Inside, you'll get Tom's commentary on gold, the dollar, the rand, the bond, the XAU, the HUI, and detailed coverage of nearly 25 mining stocks. He'll give you the entry price, price target, and stop price of each stock trade. The Gold Report is a long-term newsletter where the focus is on building real wealth through the management of a successful portfolio of gold stocks. With a lifetime of knowledge and almost 12 years of writing his informative weekly newsletter, The Gold Report, Tom O'Brien can provide you with the important market information to help you make better trades in the gold market. Don't let the next bull run in gold pass you by. To get a month-long free trial to The Gold Report, an $85 value, visit the front page of TFNN.com today.
David White's newsletter, The Technology Insider, is focused like a laser on finding the next big things in technology. If you had invested only $10,000 in Microsoft in 1986, you'd have been a millionaire by 2000. Disruptive technology like Microsoft's is the key to these massive long-term profits, and the Tech Insider is the vehicle from TFNN to capitalize on these opportunities. This is the go-to newsletter that identifies, monitors, and profits on mostly little-known cutting-edge companies with great long-term prospects. David's experience is as an inventor of Emmy-winning animation products for TV and Hollywood that propelled a company public. Match that with 14 years as a full-time trader, and he's uniquely qualified to guide you through the light-speed world of ever-evolving high-tech. If you're ready to ride the next big technology bull market for less than $40 per month, log on to TFNN.com and get your 2-week free trial to the Technology Insider. Get in on the ground floor of the next big thing today.
Hi, I'm Steve Rhodes, host of the Trader's Edge heard daily at TFNN.com and author of Mastering Probability, a daily investment and trading newsletter service that I send out each morning by 8 a.m. My morning newsletter service covers exactly what the markets have been doing since last night's close, providing you with an edge on your trading day ahead. You get actionable trading ideas, including the exact entry, stop, and profit targets. Plus, I'll teach you the patterns and hidden market correlations that will make you a better trader. As a subscriber, you'll gain access to my 90-minute money management workshop, where I'll teach you the secrets that'll save your assets. The bottom line, I've got your back, including a 30-day money-back guarantee. See for yourself the type of analysis I provide each trading day by signing up for Mastering Probability today. With nothing to lose, this is an offer you should not pass on. Mastering Probability can be found under Trading Newsletters on the front page of TFNN.com.
Catch Larry Pesavento, a 40-year veteran trader. He uses pattern recognition, Gartleys, butterflies, ABCs, and Fibonacci in order to trade these markets. Trade what you see. Next on TFNN.
Hi, guys. Welcome back to the show. And got about 4 minutes left here. Want to answer a question somebody had about the euro. And here's our scanner showing where the euro is and those inflection points I was telling you about, 114.67. There's the 112.26, and there's that 112.07. So that's why, and again, you know, these are all here in the landscape view. There's the 112.07, there's the 112.26, and there's the level of the market. So we need to breach that area to start feeling rosy about shorting this thing again, or get back up into these, mainly into this one, this 114.66. You could probably try to pick a battle also around 113.47, 48. And again, these are just, again, areas to kind of pick your battles around. I mean, it's very, you know, you have these indicators, the canned ones, the ones that are, you know, whatever, the ones that are out there. There's like a zillion free on every chart and package. And you know, by the way, you know, we're talking about prop traders. We put the same information in front of 10 of them. They all tend to do different things sometimes. I mean, with the exact same information. And I'm actually happy to see that, because if everybody's on the same trade, it's very can be very risky for a firm. But you know, everybody tries to put their own unique twist on information, And what we try to give people is just a fundamental foundation to stand on to move forward in. It's really up to you to kind of tweak that in your own unique way by, how much do you want to relax the stops? I mean, we have a lot of automated systems that do a lot of different things, and that's good. But, it's up to you to kind of take this information and, figure out your risk tolerance. And again, these inflection points are great as a starting point for that. And what your trading plan is, everybody, Bobby Sue or whatever can go out and say, you know what, I want to risk a third of my portfolio every day as my downside on a daily basis. Some guys want to risk 3%. Some guys want to risk 0.3%. That's why, scaling in, scaling out, relaxing stops, these are all things you need to have predefined before you sit in front of these screens and start banging buttons. All right. If you don't have a plan, it will take your money. All right. I hate to be so damning today, but I've had a lot of phone calls, people in trouble this week. It's sad to hear, but a lot of this can be avoided. You have to stick with your trading plan. One of my best friends in Chicago called me yesterday. He lost 30% of his account this week because he sells volatility. All right. Well, we talk about this all the time. If your whole game plan is selling volatility without the hedges, you will have days like that. Right. You can pick up 1% every week, it seems like, for free almost. But then, so again, figure out what your risk is, put the stops in, and take it from there. You're not going to make your world in one day. All right. That's not what this game's about. And it's a business. Treat it like a business. The euro. The answer to that question is somebody was asking about the where's the POC on our daily, and why is it the same? Why is it the same as why is there no blue line showing up basically on this chart? What this means really, and I'm looking at it right now, what this means really is there's no clearly defined price level when most of the trades took place. So we just opted out on showing that POC. Buyers and sellers are basically all over the place. So these are the two inflection points that we can count on from that meaty part of the bell curve where we're giving the perimeters of, right? And I hope that answers the question. So, guys, you've been great. Stay tuned for Larry. He's next. You'll be much the wiser.
Since 1984, Basil Chapman has been using the Chapman Wave methodology to advise traders of his expert market opinion. While originally hand-drawing charts from the late 1970s into the 1980s, Basil noticed that prices under most circumstances virtually always had a certain number of legs to the upside before declining sharply. Later, Basil found that computer software, which included the standard market technical indicators, enhanced the degree of accuracy in calling price turns, as well as market trend calls. Thus was born the Chapman Wave sequence. Using the Chapman Wave methodology along with other indicators, Basil Chapman advises his subscribers of his expert market opinion each market day with his opening call newsletter. Right now, you can get a 2-week free trial to the opening call, Basil's daily trading newsletter, by visiting the front page of TFNN.com. Cancel at any time during that trial and pay absolutely nothing. Get your 2-week free trial to Basil's newsletter, The Opening Call, today by visiting TFNN.com.
This is TFNN.